Welcome to Easy Stock Market, your one-stop resource for all things Indian stock market. Today, we'll delve into the basics, parameters to watch before investing in a company's stock. Before investing in a company's stock, there are several crucial parameters to watch to assess its potential and make informed decisions. These can be broadly categorized into three areas. 1. Financials. Financial ratios, key ratios like price to earnings, PE, price to book, PB, debt to equity, DE, and revenue growth offer insights into a company's profitability, valuation, financial health, and growth potential. Financial ratios are powerful tools used by investors to assess the financial health and performance of companies in the stock market. By analyzing various ratios, investors can gain insights into a company's profitability, efficiency, liquidity, and solvency, ultimately helping them make informed investment decisions. Here's a breakdown of some key financial ratios used in stock market analysis. 1. Profitability ratios. Earnings per share, EPS. This metric measures the portion of a company's profit allocated to each outstanding share. A higher EPS indicates stronger profitability. Price to earnings ratio, PE ratio. This ratio compares a company's stock price to its EPS. A high PE ratio suggests that investors are expecting strong future growth, while a low PE ratio could indicate undervaluation. Return on equity, ROE. This ratio measures how effectively a company is using its shareholders' equity to generate profits. A higher ROE indicates better profitability relative to shareholder investment. 2. Liquidity ratios. Current ratio. This ratio compares a company's current assets to its current liabilities. A higher current ratio indicates a company's ability to meet its short-term obligations. Quick ratio, asset-test ratio. This is a more stringent measure of liquidity than the current ratio, excluding inventory from current assets. A higher quick ratio indicates a company's ability to meet short-term obligations without relying on inventory sales. 3. Solvency ratios. Debt to equity ratio. This ratio measures a company's financial leverage, comparing its total liabilities to its total shareholders' equity. A lower debt-to-equity ratio indicates a company's ability to manage its debt burden and is generally considered safer. Interest coverage ratio. This ratio measures a company's ability to meet its interest expenses with its operating income. A higher interest coverage ratio indicates a company's ability to handle its debt obligations. 4. Efficiency ratios. Inventory turnover ratio. This ratio measures how efficiently a company is managing its inventory. A higher inventory turnover ratio indicates that the company is selling its inventory quickly and not holding onto it for too long. Accounts receivable turnover ratio. This ratio measures how efficiently a company is collecting its credit sales. A higher accounts receivable turnover ratio indicates that the company is collecting its debts quickly. Earnings per share, EPS. This metric shows the portion of a company's profit allocated to each outstanding share. Consistent growth in EPS indicates strong underlying performance. Understanding the calculation. EPS is calculated by dividing the company's net income, profit, by the number of outstanding common shares. Here's the formula. EPS is equal to net income outstanding shares. What a higher EPS indicates? A higher EPS generally signifies a more profitable company, meaning it earns more money per share. This can be attractive to investors because it suggests potential for share price appreciation and higher dividend payouts. However, it's important to consider other factors alongside EPS, as a high EPS alone doesn't guarantee a good investment. Dividend yield. If you seek income from your investment, Look for companies with a history of paying regular dividends relative to their share price. Dividend yield is a key metric for income-oriented investors in the stock market. It tells you the percentage of a company's share price that it pays out in dividends annually. In simpler terms, it's the annual return on your investment from dividends alone, assuming the dividend remains constant. Calculating dividend yield. The formula for calculating dividend yield is straightforward. Dividend yield is equal to annual dividend per share, current share price, asterisk 100%. For example, if a company pays an annual dividend of $1 per share and its current share price is $50, the dividend yield would be dividend yield is equal to $1.50, asterisk 100% equals 2%. This means that for every $50 invested in this company's stock, you would receive $2 in annual dividends. Interpreting dividend yield. A higher dividend yield generally indicates a higher payout relative to the stock price. 2. Business fundamentals. Business model. Understand the company's core business, its revenue streams, and its competitive advantage in the market. Is it in a growing industry with high barriers to entry? Management team. Research the expertise and track record of the company's leadership team. Do they have a proven ability to navigate challenges and drive growth? Recent news and events. Stay informed about any recent news or events that could impact the company's operations or stock price, both positive and negative. I will delve deeper into the intricacies of business fundamentals in a dedicated video. 3. Technical analysis. Historical stock price performance. Analyze the stock's price movement over different timeframes, looking for trends, support and resistance levels, and trading volume patterns. Technical indicators. Utilize technical indicators like moving averages, Bollinger Bands, and Relative Strength Index (RSI) to gain insights into potential entry and exit points for your investment. I will delve deeper into the intricacies of technical analysis in a dedicated video. By thoroughly analyzing these parameters before investing, you can increase your chances of making profitable investment choices in the stock market. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe. For further inquiries, feel free to leave a comment.